To markets news now, the Bank of Japan has maintained ultra-low interest rates but says risks surrounding the U.S. economy were somewhat subsiding. This, of course, signaling that conditions are falling into place to raise interest rates again. The lender of last resort also projected inflation to move around its 2% target in the coming years, stressing its resolve to keeping hikes borrowing costs if the economy sustains a moderate recovery. Japan's benchmark Nikkei dipped 0.5% at close of business to 39,081. Hong Kong's Hang Seng rose to 0.3% to 20,433, while the Shanghai Composite fell 0.3% to 3,274. The Nasdaq and S&P 500 closed lower as chip stocks tumbled and investors await a host of corporate earnings. Microsoft and Meta platforms are set to report results after the bell, which are expected to provide insight into whether heavy AI investment is translating into better company performances. In the Wall Street, the S&P 500 slipped 0.3 to 5,813 after drifting between small gains and losses several times, though it's still near its all-time high set earlier in October. The Dow Jones Industrial edged down to 0.2% to 42,141, while the Nasdaq Composite slipped to 0.6% to 18,607 from its own record set the day before. Now here at home, the South African rand depreciated slightly towards 17 rand 70 per US dollar after the Treasury projected larger deficits and debt in the next 3 years. Meanwhile, the economic growth outlook was improved only marginally, underscoring the heightened need for attracting additional investment. The JSE has extended its losses, with the all share falling over 0.5%. The rand is currently trading at 17 rand 68 to the US dollar, 22 rand 95 to the pound, and 19 rand to the euro. Gold is at $2,778 an ounce, platinum at $1,010 an ounce, and the price of Brent crude oil is at $72.70 a barrel. Patrick Matidi from Aluwani Capital joins us as our market commentator for today. Welcome to On Point, Patrick. Yesterday was a very busy day on the economic calendar. How has the market read the Godongwana midterm budget speech?
Yeah, good afternoon and thanks for having me. I think the initial reaction was a little bit negative. So we saw, the exchange, the JSE, the bond market and the currency weakened. But as the day progressed, leading up to today, we are seeing the markets digest, some of the numbers, and then some recovery from yesterday's closing. But certainly on the equity side, we are still on the back foot. And I think part of the challenge is just the debt, which remains very, very sticky. And I think, that means that especially for the bond market, you are likely to see Treasury coming back and borrowing more, especially if the economy continues not to perform as evidenced by, below target, tax revenue collections.
Yeah, there were some positives in that business, for instance, we're quite happy with in terms of plans on infrastructure spend. Do you think that going forward that would be enough to appease things like the ratings agencies going forward about the plans that South Africa has to get its footing on the ground and things getting better?
Yeah, I think, if you look at the past, we were not short on plans. There's always been a plan. I think the biggest challenge we continue to experience is that of implementation. So if we start to see signs of implementation of all the plans that have been outlined, so-called shovel-ready projects, I think you could start to then expect, the rating agencies and the financial markets overall, to start turning positive, on the back of tangible evidence of actual delivery.
Growth prospects being lowered down slightly. When one looks where South Africa comes from with its growth projections, there was a time where we're not growing even at 1%, but now we're talking about 1% and even 1.6 to 1.8 in the next coming years. Where to from here with regard to focus areas that could keep growth steady and growing at a sustainable pace?
Look, certainly, 1%, it's just not enough, even if we get there, to can alleviate unemployment, inequality. So we do need, structural reforms as articulated in Cooperation Vulindlela, for those to be implemented, and then for that to start bearing fruit in the form of an uplift in GDP. I think if you look at Operation Vulindlela, I think we've done very, very well on the energy side. I think today is 216 days with no load shedding. So that is good because it provides an environment for business, to can actually thrive. We need the other areas within the Operation Vulindlela to also be implemented so that holistically, these reforms, start to work together and you start to see, not only confidence on the business side, but also consumer confidence and also to see the economy doing well. I think thankfully we are on a rate cutting cycle. So hopefully that does boost the consumer. We have the 2-point system. Hopefully that also filters down, and actually boosts the consumer and the consumer spending. But you almost need all the levers at our disposal to start to work together to can deliver an above average growth profile going forward.
Yeah, Stats SA data that's released out for September for the producer price index has increased by 1%. What does that tell us about the state of factory gates or final manufactured goods when you put it against consumer price inflation and PPI? What would we read into that?
So in the past, a lower PPI was always a leading indicator into a lower CPI. But given some of the changes in the composition of the CPI basket, that transfer mechanism is no longer that tier. However, if you look at the PPI number as reported at 1%, it is the lowest we've seen since 2020. And that alone means that there is no pricing ability from the manufacturers into the consumers. Right. So as soon as you see prices coming through, the producers have to absorb them, because if they were to push them onto consumers, the consumer will just battle because the consumer has been very stressed. So it just means that there is no pricing power, which is not a good thing, because you do want the producers to also be able to pass on the pricing pressure onto the end consumer, and you also want the end consumer to be able to absorb those price increases for the entire system to work well. So hopefully going forward, you do start to see a bit of easing, but for now, as things stand, it just means that the state of manufacturing in the country is still in a very, very difficult situation.
I just have a minute left with you, but I'd like to hear your thoughts about the upcoming U.S. elections and how they're likely to impact our local markets once done.
Yeah, so I think for the next few days or so, the focus will shift from inward factors like the NTBMS into the U.S. elections. I think the earnings side of the U.S. also will be a focus, but a little less so. The implication for financial markets and global is massive, because irrespective of which candidate comes in, their policies are very, very different from one another. So policy uncertainty becomes a matter of interest for investors, where you want to know what you have been used to in the past, if that is likely to persist. If not, what are the likely changes and implications for how we are invested? I think the main area of concern clearly is if Trump were to come in. His policies are very different, from the Democrats and also from the Republicans. So you could see, what we saw earlier on when he was president, the so-called trade wars, come back, and that obviously will have an impact on the likes of South Africa, the likes of China, for example, which is our biggest trading partner.
Patrick, thank you so much for your insights. Always appreciated. Patrick Matidi is with Aluwani Capital. He was our market commentator for today.